We're going to talk here about Glo-Bus, give you an introduction to Glo-Bus, and also talk about the concepts in Chapter 19, using securities, which is basically the stock market. Those things are related, and so you'll see in a bit, how those things are related. One thing you have to understand is that not every company is on the stock market. Most companies are actually private, and if you started your own company, that would be a private company and only after you applied would you be able to put that company on the stock market to be publicly traded, so other people can buy a share of it, and then you can receive their money for investing in your company. Now, if you want to do that, there's a lot of requirements and a lot of restrictions. So many companies choose not to go public, go on the stock market, because once you do, then you are subject to a lot of laws and regulations. You have to do your accounting a certain way. You have to report your accounting. All your books need to be open. And one of the reasons why you would want to go public is for the initial owners and the people who created the company to get the full value of their company. If they want to just sort of cash out and retire or do something else and move on, that's the way of getting the full value of the entire company in their pockets. Once you go onto the stock market, you can always exit it. Sometimes major investors will buy up the stock and then take it off the stock market. The advantages of that is you'll have more control. You're not subject to government regulation, and you can make decisions that maybe stockholders might not like. So if you wanted to do, let's say, a long-term strategy, the stock market typically doesn't like that. They like short-term. So you might want to do that. Or if you want to do something that's socially responsible and that's not going to maximize profit, that could be another reason for doing that. Okay, why does this matter for Glo-Bus? Because you would think that the company that gets the most profit wins the game. That's really not the case. The idea is that you are publicly traded companies, and so you are really trying to impress stockholders. And there's a set of things that impresses stockholders beyond profit. Profit's always part of it, but that's just one component. Investors look at something called key performance indicators, KPIs. Those are numbers, typically ratios, just simple ratios. Highly recommend you keep these ratios in mind, because that's going to tell you what the impact on these numbers will be. So earnings per share is one of them. EPS, earnings is profit, another word for profit. Return on equity is another one. Return, again, is just profit, different name for that. Equity is simply the amount of money shareholders paid to buy their shares and any cash on hand. So those are two very simple ratios. Also in the game, stock price, credit rating, and image, which is your public perception of your company, of your product, and your brand. Those are the remaining victory criterion. So those ratios and those numbers determine whether you win the game. And you can see that Glo-Bus is going to give you lots of reports to track these things. So these are over time, over year 6, 7, 8, 9, etc. to year 15. You have all the companies A, B, C, and how they're tracking. And some companies are doing better than others. Earnings per share, return on equity, stock price, etc. And what you can do is take a look at these and see how you stack up against other companies, and then maybe identify another company that's doing well so you can imitate them. So EPS, earnings per share, is just a simple division. And so if you increase the number of shares, then you are lowering that number. So if you issue shares, let's say to raise some money, then you are going to hurt your EPS. Same thing with return on equity. If you issue shares to raise some money, to invest in things in your company. There's also a return on equity And that is going to be, again, a very simple ratio. If you sell more shares to raise money for invest in your company, then that's going to change that ratio. You're going to increase the bottom part of that formula there, and your number will go down, and that's not good. So you should have a plan for bringing that number back up towards the end of the game. In addition, you'll have credit rating, and that's determined by the amount of loans you have out versus your current assets. So banks want to only loan to people who really don't need it. So the more you have loans out and don't have a lot of money on hand, the less banks are willing to loan to you, and the higher the interest rates will be. Image rating, and that's going to be whether the public knows what your product is, likes your product, knows what your company is, and has a good feeling about your company, nice, warm and fuzzy about your company. And then obviously stock price. Why are ratios used instead of just raw profit? An example here is, let's say there's two companies both earning $100,000 profit. What's the difference? Why, how do you know to invest in one versus the other? Well, company A has $100,000 in profit, but it's based on $50,000 in investment. And so that's 100 shares at $500 a share, ROE of 2.0 and EPS of 1,000. Company B has an investment of $5 million and has a profit of course, of the same profit of 100,000. And so that actually is providing a lot less, or actually the same profit for a lot more investment. So obviously, company A has some excellent numbers because it's doing a lot with a very small investment, and vice versa. So what is a KPI for evaluating college student success? Can you think of what one number provides insight into the overall performance? Can you think of a ratio, a very simple ratio that tells you whether your overall success, what your overall success is as a student? And that, of course, is your GPA. And you would calculate that's basically an average, and then transformed into a 0 to 4 scale. So that gives you an overall idea of how well you're doing. Now, how do you play the game? You're basically going to use decision screens. There's standard set of decisions that you need to think about. One is the design of your product. What's the quality of the components? Do you want it to be high end, low end? High end means it's going to cost more. The price has to be higher. And then you want, that's also going to, help determine the public perception of the performance or quality rating of your product. Obviously, when you go into a store, you're considering two things. One is price, but the other is how much you're getting for the price. What's the quality of that for the price? So that's a key factor. Marketing decisions, obviously, so you have one key decision is the price. If things are higher price, obviously you're going to think twice about it. And lower price means, depending on your cost, that could be more people buying it, but less margin because you're not charging enough. You're not going to make a profit per sale. One way around that is to sell a lot and make your profit by taking a very small margin from each item sold. Or you can sell very high-end products and then take a high margin. You'll sell less of them, but that's another way of making profit. Then you have warranty, and warranty we'll get into later on. If you give an extended warranty, people are going to want to buy your product, obviously. But at the same time, what does that mean? That means if there's anything wrong with them, you're going to get more returns. So that's going to be a higher cost, and you have to take in that into consideration. If you do that, you may want to look into investing in ways of making your product more reliable. In other words, reducing mistakes in the production process. And you would do that in the compensation and facilities screen. That's going to allow you to make adjustments so that the product is more reliable. But it also, if you do some marketing and you're going to get more demand, then you got to make sure that your production is able to meet demand, and you have to look at what your production costs are. If you can reduce those costs, then you're obviously going to make more profit. Corporate citizenship, we talked before about image or brand. One way of maintaining your image and brand is to invest in corporate citizenship, and that's going to be stuff like giving your workers a cafeteria. That's going to be things like protecting the environment, or things that the public finds endearing, and that'll increase your overall image, which is a victory criterion in the game. Always, you need to understand how are you going to pay for stuff. So you need to look at your finance and cash flow screen. Now, how exactly, step by step, are you going to determine the choices that you make, if they're good choices or not? One tool that the game gives you is this projected performance box, and those numbers will change whenever you make a decision. So this is the picture of the design screen for action cameras, and if you change those, increase or decrease some of the components, you're going to see that the performance quality rating at the bottom, which now is 6.7, will increase or decrease. And you're also going to see on the screen on the right there, you're going to see those numbers for earnings per share, return on equity, credit rating, and image rating, and things like that, as well as net revenues. Those will change. Those are going to give you estimates. They may not happen because your competitors may do something weird, but it gives you some idea of the impact of your decisions. Now, that is not the only consideration here. Sometimes you want to make decisions that are going to lower those numbers because you're making a long-term investment that's going to pay off later on. That's going to put you in a much better position. So you're always going to be doing some tweaking, but that should not be your strategy. Again, sometimes your numbers will go down in short term, but in the long term, you're making an investment, they'll go up. So you want to think, how are you going to be in a better position 3, 5, 7 years from now? If you end up with much lower costs than anybody else, if you end up with a higher market dominance, and if you end up very differentiated from you're selling something in terms of your product quality and your price, very different from other people, then you're going to be more successful. So long-term commitments have to be thought about in the beginning of the game, and that's going to be whether you want to invest in R&D, in dividends, corporate social responsibility, or if you want to invest in market dominance, things like that. Now, how do you raise money for long-term investments? If you choose to invest early in the game in order to lower costs or increase your market position, one way you can do that is by issuing shares. The upside of that is you don't have to pay it back. Downside is that your metrics, your KPIs, which is your ROE and EPS, will be hurt. And so you should have a plan of how you're going to make up for that. Now you can actually buy back your shares at the end of the game, so you might want to think about that. You can take out loans. The problem with that is you're going to have to pay them back, and there's going to be interest. And the problem that also lowers credit rating, which is a victory condition. So you have to have a plan. Am I sure I'm going to be able to pay this back? Is it worth the overall cost of these loans? And how am I going to make sure I pay all these loans back before the end of the game to recover my credit rating? Then you want save profits and cash over time is another option, instead of taking out a loan or raising money. The problem with that is it takes a long time to save money, and therefore you won't be able to make very bold moves that other companies may be making. So in general, it's highly advisable to have a very clear strategy and plan. And one example for that is to gain market dominance. Once you have strong market presence, it costs less to maintain that than to gain more profit, or more market share costs more. So you're putting yourself in a better position by gaining market dominance. That means share of the market. You can enhance your brand and image through investments in corporate social responsibility. You can automate early, which is going to lower your production costs, increase the reliability of your products. So those are some examples of what you can do. Other examples include R&D, dividends, and things like that. If those investments work, then you should have lots more money at the end of the game, and then you can use that money to buy back shares, pay off loans, and that money will also go into those ratios there. That's, the profit is obviously part of that ratio. If you increase your profit, that's obviously going to increase all those numbers. So at the end of the game, you might be in a much better position. You have to pay for these with the finance and cash flow decision screen. You can see here's where you take out loans, here's where you issue stocks, here's where you buy dividends or pay dividends, here's where you pay back loans or do a stock repurchase. Credit rating specifically is determined by consistently paying back loans and your current ratios. In other words, how many loans you have out versus how much cash you have on hand. And again, banks don't want to loan to you if you actually need it. If you have lots of money lying around, they're very happy to give you a loan. Stock price is related to other metrics. So if your ROE and EPS is high, then people want to buy your stock. And if you give out dividends, people want to buy your stock. Stock prices impact also by your image rating. So how people feel about your company and whether people have personal experience with your product. And so that's market share and also corporate social responsibility investments, which is public relations basically. You can increase your stock price by consistently issuing dividends over a long period of time. And so you can see stock prices related to EPS, ROE, dividends, and consistently good results. If the stock market and business in general likes consistency, they like to see a track record, and then your credit rating. So you can see how all these things are interrelated. Now, the image rating in particular is influenced by primarily your market share. So people are buying your product or talking about it. They have a personal experience with it. It's also influenced by your PQ rating, which is your performance quality. So the quality of your product in terms of the components is, do you have lots more features than other people? Do you have lots more stuff going on with your products? And in addition, you also can invest in PR, which is corporate social responsibility. You should do several of those things, not just one, and you should be consistent with them across the game. And if you do that, that's going to increase your image. And that's all the stuff I just said about image. PQ rating is managed with the product design screen. So PQ is important because that's one reason why people buy stuff. If you go out, you're looking to get the most for the best bang for your buck. You're trying to get the most you can with your dollar. And so if something has a good reputation for having high quality components, that's the thing that you want. And that's one criterion for selling. The other, obviously, is price. So it's always a ratio between the two. And so you have to sort of decide at a certain point, what is the quality of the components of the products you want to sell. You can go high end, and then you'll have to charge more, and fewer people will be able to buy it. But you might get lots of profit per sale, and then you can go low end, and more people will probably buy it, but you'll probably not be able to get as much profit per sale, so you'd have to sell a lot of them. Okay, victory conditions. Again, raw profit is not the victory conditions. It's whether you're making investors happy. So there's actually two parallel ways they rate winning the game, and they give you points. One is meeting investor expectations. So if you consistently do what investors expect, then they get confidence in you and they'll reward you. So you got to consider, what you're doing here is you're acting as a manager. You're reporting to a board of directors, and the board of directors is thinking about the stock market. And so they're looking at you and saying, okay, are you making us look good in terms of the stock market? And so if you meet those expectations, you get points to win the game. You can also, there's also points to be had for just simply being the best in the industry. Well, your numbers are the best. So first place, second place, third place, gets the highest and lowest, numbers. Then there's bonus points if you're very consistent in meeting your expectations, or if you outpace your expectations, then you can get bonus points. So here's the scoreboard. You could see that there's investor expectations, there's best in industry. They average them together, and they tell you the change from year to year. The overall game-to-date score is how you win the game. All right, let's review again strategies to win the game, because, this is always the toughest part for a lot of students. All right, now the early big decision make is whether you want to invest. And if you invest, you have to raise money. You can invest to reduce costs, which might involve automation or R&D. You can invest in increasing market share, and that allows you to sell more, and that gives you the advantage of less marketing costs to maintain the same marketing position. Market dominance also gives you higher image or brand rating, which is another victory criterion. You can also increase your image by investing in corporate social responsibility, and you can maximize stock price by issuing dividends. So you have to decide early on whether you want to do those things, and they have to be done consistently throughout the game. There are a lot of interrelationships in the game. If you are not aware of them or you ignore them, you're going to have problems. So if you decide to increase your market share by increasing warranty, what's going to happen is you're going to increase the costs that come to you, because the longer the warranty, the more returns there are. And if your products are not reliable, you're going to get a lot of costs coming back to you. So you might want to think, well, I need to manage reliability. How can you do that? You go to the production compensation screen, and you maybe pay workers more, or you pay them a bonus for quality, or maybe you automate, but you do something to reduce those costs of returns to make the product more reliable. How do you do that? Let's say you just choose to automate. Well, then you have to think about how you're going to pay for that, and what's the impact of the way you raise money. That's going to cause another problem. So the students who understand all these interrelationships and manage them are the ones that are going to win. Again, you can tweak. Every single decision you make is going to show up in this projected performance screen. But you should do more than tweak in this game. You need to have a strategic plan. 3, 5, 7 years from now, how are your costs going to be lower? How are you going to have what market dominance do you want? What long-term investments do you want to make? And how are you going to pay for it? The participants guide, which you'll be forced to read later on, is going to tell you that, or suggest these strategies for winning the game. And they suggest that there's no one way that's better than the other. You can go low cost, low price. So basically, you have the lowest price, and you're going to get people who want a product and don't want to pay a lot. And what you may need to do there is to sell a lot of them, because you're probably not going to have high margins if your prices are very low. margins meaning profit. So you'll want to consider managing your costs. You always want to differentiate yourself. Businessmen do not like competition. So if you had, a pizzeria and another pizzeria opened up next door, you'd be upset. And so what you would want to do is make sure that, your pizza was very different, and no one else could actually produce that. So you're going to put pineapple on your pizza or something like that, and no one else is willing to do that. In any case, you're going to look at other companies. You don't want to do exactly what they're doing, because then you're splitting the market. So the people, let's say if you had a quality, a very high quality product, and other people had the exact same quality, you're going to be, those people who are willing to buy at that quality, interested in that quality, are going to be split between you and them. So you want to differentiate yourself. You can go for a more value for the money. Look at what other companies are doing, and basically have a lower price and give them higher quality, and people will buy your product. You can focus on dominance in one product or another. And so you can say, well, I'm going to not lose money on cameras, but I'm basically going to put most of my resources just in drones, so I can really outcompete everybody in drones. Same thing with the geographic areas. There's 4 geographic areas you're competing in. You can decide, okay, I want to be dominant in Asia, and I'm going to put all my resources in Asia, and I'm going to just hold my own in the others, and just not lose money, but I'm going to clean up in Asia. That could be a choice you make. Okay, one thing to keep in mind is these 4 regions. Now, there are customer preferences in these regions. So Asia and Latin America are price sensitive. North America and Europe are quality sensitive, which is the PQ rating. There's also import duties to consider. And so depending on where you're selling, that's going to be taken away from you and take away from your product. There's also exchange rates. So you're going to be trading in Taiwanese dollars, I think it is. And so if you were to trade with US dollars, in other words, sell products in the US, because of that exchange rate, you would get more profit per sale. And in this case, you're going to be, if trading in Europe, in the euro, Brazilian, or Latin America with the Brazilian real, or with Singapore dollars, in other words, Asia, you're going to have a poor exchange rate, and that's going to have a negative impact on your revenue. So in other words, your profit's going to go down. Okay, so again, strategy, to reiterate one more time, to beat this thing hopefully to death. How are your costs going to be lower 5 to 7 years from now? How are you going to make sure you meet demand? What are the costs of your production? How can you lower those? How can you increase the reliability of your product to lower costs from returns and long-term warranties? How are you going to gain market dominance, or do you want to? How do you avoid direct competition? What are your long-term strategic choices in terms of robotics, R&D, worker training, dividends, corporate social responsibility, market share? What are your choices? Do you want to choose one region or another to be dominant, or do the same thing everywhere? Do you want to choose drones and cameras, or do you want to compete in both of them? And what you want to, you're always going to start with a strategy, and then you need to review that. You don't want to review it immediately. You want to give it a few years to see whether it's panning out or not. But then you want to review that and probably tweak it 3 to 5 years into the game. Alrighty, that's all she wrote. Thank you.